The one certainty in the prevailing investment environment is that the world has changed fundamentally. It means that investment strategies that worked in the past may have become redundant. Henry van Deventer, Head of Business Development at Axis, joins us in studio to discuss his views on this theme. Welcome, Henry.
Thank you.
So a great deal has changed. Did it start before 2008, and how fundamental, how deep is the change in the world economy and financial system?
Well, although we saw the big bang happen in 2008, the reality is for most of us, had we remained relatively unchanged and we had the traditional exposure of predominantly equities, predominantly listed property, even today, looking back over the last 10 years, we would still have some very, very favorable returns, some very favorable real returns. So even if I failed to change when the world changed in 2008, many investors out there may still well be in a position where they think, but hang on, I can just keep doing what I've been doing because on average, I'm okay. The reality is there's been a fundamental shift in the world, not only in terms of geographically how the new and the old economies are behaving, but also how asset classes are behaving. And the reality is if investors fail to take account of what those changes are and adjust their investment strategies accordingly, it's highly unlikely that 10 years down the line they'll still be smiling.
Yeah. I must say I concur. Things have changed where you've got this thing called financial repression that's starting to come increasingly, where interest rates are being suppressed at low levels. And what's happening is that increasingly we've got a problem now, is that normally these assets, cash and bonds, are there to protect you from risk and that sort of thing. So normally in normal conditions, if you feel things are risky, you'd buy cash and bonds. And in fact, that's how the investment world works. If you are sold a conservative or safe sort of investment, it's because it's got cash and bonds in. And yet increasingly we're seeing cash and bonds becoming actually not the refuge from risk, but the epicenter of risk. If you're sitting in Greece and your financial advisor sold you a conservative portfolio which only had bonds and cash, and that's Greek bonds and Greek cash, and you would actually think, no, that's not correct. And this is where it's breaking down. We're also getting a problem where governments will be trapped in low interest rates environment. The Japanese government is already there. And so if inflation rises and you're sitting with debt to GDP ratios at very lofty levels like 200%, you can fund yourself maybe at 0.5% or 1%, but push that to 1.5% or 2%, suddenly you're bankrupt. So you cannot do it. And so what's going to happen is to preserve value. It's not just what you put in, I put 100 Rand in and I'm getting 105 Rand out. What is the spending power, the value that you're getting out? And that's going to be you're going to be taken to the cleaners if you're not getting a real yield above inflation.
Henry, what I'm hearing is with the change in the world, it's about lower growth from most of the asset classes, and also the way Chris has now described it, it's almost the unknown. You're not sure how prices and rates are going to behave.
Well, one thing that is certain, if you look at broad economic consensus out there, is that we are highly unlikely to see asset classes generate the kind of returns that we've seen over the last 10 years. And this is quite important from a behavioral perspective. And to back myself up, I'll refer to a study that Barclays did quite recently. This was just before the European Cup in soccer. So what they did is they looked at goalkeepers in international soccer, and they looked at how they kept during a penalty shootout, and they found that 19 out of 20 times, 94% of the time, before the ball was kicked, they moved to the left or they moved to the right. The ball was kicked to the middle 1 out of 3 times. So just by doing nothing, they would have done much better. Now in behavioral finance, this refers to a bias called action bias, and what that basically means is as soon as we start feeling that we're not seeing the results we want to see, we start taking action. And by the way, men do so more than women, which is why statistically women are better investors, but I'm not even going to get into that right now. What this does mean though, is if your expectation of success and what you expect out of your investment strategy is based on what happened over the last 10 years, we now really start running the risk of wanting to take action, wanting to fix something that ain't broken. What we need to understand is listed property, equities, those star performing asset classes over the last 10 years won't remain the star performers over the next 10. in the same way that they have been.
But if you say that, from what I've heard from other fund managers, it will still be the better choice amongst the asset classes, but not delivering to the extent that they have in the past. Do you agree with that?
I agree with that. Again, but what we are going to see, to a great extent, also some reversion. I mean, what we've seen out of South African equities, for example, over the last 10 years is real returns of 12.5%. We're going to see reversion down to 8%. Listed property, we're expecting to see massive reversion, etc. And at the same time, we're starting to see some other asset classes, such as global equities, starting to pick up very nicely, taking into account Chris's concerns, because they are exceptionally valid concerns. What that means, in short, is whereas there were 1 or 2 options in the past, now suddenly there might be quite a few more, and we need to stop thinking about which shares to buy and start thinking in terms of appropriate global asset allocation.
No, very much so. You're getting what I think is return asymmetries that's starting to become quite big, in the sense that, let's take US bonds. You lend the government, US government, 10-year money at 4%, and you get 4%, and the yields kick down to 3%. It means that you get 4% plus the capital gain, and the returns are fabulous. And now the yields come down from 3 to 2 to now 1.5 and that sort of thing. You now get to the point where it's at 1.5%. Inflation is above that level already, so you're already starting to lose value on that point of view. Now, to get any gain, you're only getting a 1.5% pickup, and you still need those yields to go down to 1% to get any reasonable return. Whereas it's much easier to see when you're getting negative real return for these things to kick the other way.
Right.
Now, you don't know what's going to happen, but in terms of the risk profile, the probability of you losing money is much greater than the probability of you gaining money. And you have to really start to massage the scenarios to say, in this scenario, we might gain money and therefore we'll still hold them.
Henry, so this is about asset allocation. You said how important that is in the entire portfolio management process. It's not so much about the individual bonds or the individual stocks that you're selecting. And you also make the point that it's active asset allocation, so not necessarily buy and hold and maybe watching the bands, but actively, possibly strategically altering those allocations.
Absolutely, and that's going to be so much more key over the next 10 years, because what we're starting to find is your new economies are starting to play a much more pronounced role in the global economy. Now your new economies tend to be a bit like minibus taxis. They get you there quick, but they run in fits and starts. If you look at the last 10 years, it's been a bit like being on a train. The US economy predominantly drove what happened in the world. So in understanding that, we need to understand that, yes, there is growth to be had over the next 10 years, but understand the nature of that growth is going to be different. And because there are said to be so many more fits and starts, not only in the equity environment, but also in looking at those other asset classes, active asset allocation is said to be a much more beneficial strategy than it has been in the past.
And you made the point also that whereas in the past it might have taken 3 years to achieve a certain level of return, it now could take 5 years. So greater patience.
Very much so.
I think certainly to add to that, one's got to be quite attuned to macro events. Now, we can see this in our markets at the moment, and I know you don't just take the current, project them 10 years hence. But if you've got something that's solid fundamentals and all the rest of it, and that's how you do your analysis and that kind of thing, actually what matters more is what they say at Jackson Hole tomorrow. And the point about that is that you're getting these erratic decisions that are coming in and that are driving markets to peculiar levels.
Because of the power of policymakers at this juncture.
Policymakers have got quite a lot of power, and we can see this in the markets. And this is why one has to be attuned, not just to the bottom stock picking strength, which many of our managers are exceptionally strong at, etc. But one needs to actually understand the top down as well.
Henry, going back to active asset allocation, right at the beginning of this interview, you spoke about the importance sometimes of sitting on your hands. I'm not sure if that's exactly what you're advocating. How does one marry that with active asset allocation, where you're keenly watching what the policymakers are doing and saying? So when does one intervene and change one's structure?
Well, I think firstly the important point is to have a very sound framework, decision-making framework, that gives you clear guidelines around when and how you see yourself asset allocating. Whether you do that yourself, whether you choose an investment manager to help you do that, we need to understand what that framework is. So doing something necessarily is not a bad thing. It's doing the wrong thing that is completely going to kill you. And the thing is, us men especially, we want to jump up and do something purely for the purposes of doing something. So if you're going to asset allocation, understand when, why, and how that's going to be necessary. And whoever's managing your money, whether it be you or somebody else, understand if their framework speaks to that.
So these are rules to check your behavior so that you're not acting out of panic and out of fear, but a well-reasoned argument before you increase or reduce equities. Would you still be overweight on equities? I know it depends on your time horizon and your risk profile, but would that still be where the most returns are coming from?
Pretty much that's what the expectation is. The one thing that has changed is global equities over the last 10 years have not been fantastic, and especially with the emergence of the new economies. We're expecting to see some more growth come out there. Locally, very much our expectation is that we'll see South African equities dominate in the local space, with South African properties coming back quite a bit. So if you are going to be growth focused, not a bad place to be, but don't expect as much as you got in the past, and if you don't get it, be prepared to sit on your hands.
So that's your hedge against risk, to make sure that you are getting some growth from the right kinds of assets.
Exactly. And one also needs to distinguish further to the risk is that assets that have their own intrinsic value may actually do better than assets that depend on confidence for their value.
You're talking about property as opposed to paper?
Property as opposed to bonds and cash, especially when you're seeing that shift to risk.
And of course, you hadn't mentioned gold, Chris.
The precious metals are important because they do have their own.
Henry, he's a gold bull.
Well dodged.
No, he's not dodging.
No,
he loves gold.
I don't dodge it. I'm very happy with it.
How do you
we
feel
all
about
have our
gold?
faults.
Yeah.
Exactly.
There you go, you've answered my question. On that point, would you promote the holding of any commodities, say ETFs, platinum, gold, copper, anything, futures, anything that gives you exposure to tangible assets?
Well, I'm not going to drill down into specifics, and Cunning going to George. Suffice it to say that if we're going to look at understanding and finding value, especially in the local environment, there certainly is a very comprehensive argument in favour of resources.
What would you be avoiding?
Well, right now, I mean, if we're going to look at this on a sectoral basis, purely from a valuation perspective, resources would look attractive. I'd be kind of cautious when it came to sort of looking at some of the financials, industrials that we saw running early on. There's still some value there, and I guess if you're a global investor, what we've seen over the last few weeks is they believe there's still a lot of value there. So, if you've got a global perspective, then maybe the answer to that question is going to be different.
Yes.
Yeah, well, very much so. It must be measured and understood. It's value preservation and also value creation, and that's going to be critical.
In a way, you misunderstood my question when I asked you what would you avoid. I meant more broadly in terms of the asset classes. So you said you would be overweight equities. So would you be as wary as Chris seems to be of cash and bonds, particularly the developed market bond issuances?
Erika, my wife each morning tells me I'm a very brave man. I'm not quite brave enough to be touching cash and bonds in the global environment right now. I mean, there's so much uncertainty aside from the sovereign risk, that we spoke about before the show as well. I mean, a month and a half ago, on your 2-year German bonds, you were getting negative yields, and we certainly don't expect to see a significant shift in fundamentals that's going to change that outlook in the short term.